Hey guys, I just want to do a quick, video on my option strategy for SAVA, S-A-V-A. This is the Noob Trader 2020 channel, and I'm not a financial advisor, and I really don't care what you do with your money. This is just how I trade, and just my opinion on trading with options. So let's get started. So I've been watching ticker symbol SAVA for, I don't know, it's been over 2 years, probably 2.5 years. I don't mind saying this at all because it is what it is, but I had like $3.30 share price average. I think I had a couple hundred shares, and then I had shares when it was $8 and $10 before it tanked down to $2, and so I've been watching it for a while, but I had gotten out of playing just buying stocks. I was just done with that, and I just write options now. That I don't really do any other kind of trading. It's just not my style anymore, and so I've just got away from it. So let's quickly get into, I've just bought, I picked up on Friday afternoon, I picked up 400 shares of SAVA at around $60 a share. And the whole strategy behind that is I wrote some covered calls, and I'm going to tell you why I wrote the calls I wrote, and then my strategy on how to play the stock as it goes up or down, and then why I'm playing, rolling my calls or playing these options a certain way. So I think it spiked up, and then it went down here, and it went up to like 140, and then it was spiked up, and now it's at like, it's down here at like 57.50 or something like that. This is like 120. And what did you say this was? 55 or 40 or whatever. So I've been watching SAVA for a while as it made this huge run up. I saw the day that it exploded, and I was like, oh, that would have been a lot of money if I had had a position, but I didn't. So I bought on Friday because I was like, hey, it's been beat up pretty bad. I felt like it hit this area of $50 through $35. It doesn't mean it's gonna bounce, or I don't know. I have no idea what it's going to do tomorrow. Tonight's Sunday night. I have no clue what it's going to do tomorrow. But what I did do is I got 400 shares Friday at like 1 o'clock, and I sold 4 covered calls for the 70. The weekly strikes, and my purchase price is around $60. And I got around $5 per covered call. And I'm just shortening that out by CC for covered call. So I made around $2,000, and that was roughly, that was a little more than 10%. I think it was like 11%. Yeah, 6 times 4. I had a little bit over. It's around. No, it's not 10% quite. It's a little under. It's around like 8.5. That's like, or 9. I'm not very good at math, but I don't really care. I don't have to be, thank God. Either way, that's a pretty good return for 1 week. So And the reason that I sold up here at $70, I sold it out of the money. Okay. I typically will sell at the money, or ATM. The reason I sold out of the money is stocks like this that are extremely volatile. It is not in my favor to write extremely tight because it's difficult to roll. And if I want to get out of the position with a very tight strike, it's just harder to do that because there's not as much profit in between your purchase price of the shares and where you have the strike price at for the covered call. All right, so now we're going to go into the strategy of why I wrote what I wrote, and if the stock goes down, what I'm going to do, if the stock goes up, what I'm going to do. Okay. So let's just take this area where we're in now. We're just going to dump it over here. You know, this is 140. We'll just say this is, 100. And then we'll just say this is 60, 57. That's where it's at now. So this is the area of unknown that I'm in, because let's just be honest, nobody has a freaking clue what a stock's going to do. I mean, you can try to predict, and I've gotten pretty good at that, but it's quite often you're just wrong, and that's part of it. So my guess right now is, maybe I'll get a bounce off of if this area of $57 or $60 is an area. I think on Friday it went down to like the mid 40s and bounced, which tells me, that my likelihood of coming in next week and having a decent week, or a couple of days, is better than maybe it just tanking more. But I have no idea. They could just short it into oblivion. It'll go down to $30. So let's just say $30 is here. Let's say 80's here, at this area. Of course, here's that 100. Here's 40. Okay, so I sold this 70 strike. Obviously, if the stock comes up and passes through $70, if it goes to $70, I will roll the $70 strike that I wrote for 1 week. I'll roll it to 2 or 3 weeks out for a $75 or an $80 strike when it hits 70. I do not want my calls to go deep in the money. They're difficult to roll. If it goes down, like let's say pre-market, it's down 55 bucks. I see at 4 a.m. it starts tanking, and it goes down to 55 and 50, and let's say it opens up at like $54. Okay, I got that $70 strike there that I wrote. I'm gonna roll down to a 60, okay, which is right in this area. I will roll down, but for 2 weeks. So I'm gonna roll down and out. I'm gonna sell one more time for a $60, and that's gonna give me a nice little, man, there's a lot of junk in here. This area in here of, 58 down to 30, I'm gonna have a little bit more downside protection with that at the money call. Well, it won't be at the money if it's down at 55, but at my strike price, I'm gonna roll down 10 points and out for 2 weeks. That'll give me a nice buffer in my account if the stock does decide to tank. But I also, if the stock rips back up, I'm not gonna lose any money because I rolled below my share price. So the last strategy is, let's say it's at $58, goes down here to 35, you know, and I had this $60 covered call that I wrote for 2 weeks. And let's say, you know, it just, on Monday morning, it just keeps going down. Keeps going down here. It goes down to this $35 level. I might roll down to like a 45 or 40. I'm not going to this 35 because what's probably going to happen is it hits these bottoms here and it's probably going to get, I'm going to get whipsawed. Getting whipsawed ain't no fun. Especially if you're buying options. I think you've been in that road before. Those kind of movements are designed, I have no proof of this, but they have a really good way of destroying any options, or people that buy options tend to lose a lot of money with movements like this. It just destroys the options. It makes them great for the puts on the down and then great for the calls in the up, but if you held calls here, they're screwed, and if you held bought puts down here, then you're screwed too. So that's why I just sell options. But yeah, I have to be careful. I'm still going to be selling out of the money. That way I can roll, up here, back up here to the $65 area if I need to. Just depends on how long it's down here. Usually, if stuff is really fast, if it's like a 1 or 2 day move, I'll expect a 1 or 2 day move back up. And if it goes down here and stays down here for a while, then I'll just have to change my strategy up. If I'm really worried about a stock coming down and tanking, I'll buy some puts. But something like SAVA has a very low float. I mean, I've seen numbers like 40 million, or it could be 60 million. I'll have to get official numbers on what is actually issued. Either way, the ticker moves fast. I mean, this is a fast moving stock. A lot faster than any of the other ones I've seen, and because of that, it's amazing for options, but I can get caught in a whipsaw pretty quick if I'm not careful. But I can always roll up and out, so I'm not worried. Either way, I hope that wasn't too confusing. If you guys have any questions or comments, leave them below and I'll try to answer them. Or maybe I'll have to go and do some research because I'm still learning a lot and I'm new to this. But thank you guys for your time. See you later.